Good evening, everyone. I'd like to call this special meeting of the Police Pension Board to order, please. Tuesday, September 8th, 2020 at 5 p.m. Vivian, would you call the roll so we know who's on this? Not everybody's on my screen.
Sure. Chairman Baldwin,
Yes.
Commissioner Treves,
Yes, here.
Commissioner Bazzano, Commissioner Samry. I see him on the screen. Chief Lombardo,
Yes.
John Allen,
Here.
That's 5. Good.
Edgar Perez. I see him on the screen, and Bobby Capola. I see him on the screen as well. So the
All
only
right, so
one
apparently,
is
Muted.
Bazzano, correct? And Commissioner Magliocco, he's absent.
yeah, we have 7 of them on. Okay. All right, the first order of business, quarterly report and update from Mike Guarini from Wells Fargo. Mike, you have the floor.
All right. Thanks, everyone. And good evening. I hope everybody is doing well during these interesting and somewhat tumultuous times. I'm going to make it quick because I understand that there are several subsequent meetings to this. Tell me if you can't hear me. It looks like I may be having some challenges with my internet connection, but I want to make sure that, in fact, we get through and get you everything we need. So you should have two, basically one larger presentation in front of you and then a small little handout just to provide you with some supplemental detail with more up-to-date information. So if you could turn to the big presentation first and then look at page 3 of the presentation. We'll start by taking a look at financial markets, what happened during the quarter, kind of the state of the economy, both within the US and globally, and then we'll jump into what's happened with the portfolio during the second quarter, and we'll take a slight small look at the performance through July. As soon as the August information is out, I will send that along then to Vivian to share with the rest of the committee. So looking at page 3, if you think about what happened during the quarter and what the big drivers were for performance here during the quarter, it was number one, huge levels of government stimulus. Because there was such expectation for significant economic decline in the second quarter as a result of all of the stay-at-home orders because of the coronavirus pandemic, the federal government came in with a very, very aggressive stimulus plan. With that stimulus plan, they basically put 12.3% of GDP back into the economy, roughly about $3.5 trillion to try to keep people spending money, to keep businesses afloat, to mitigate some of the dire declines that we're seeing from an economic perspective. It wasn't just the federal government, though. It was also the Federal Reserve. Huge levels of stimulus coming in from the Federal Reserve. If you remember back, first off, the Fed lowered the Fed funds rate to 0 to 0.25% in March. So that was at the end of the first quarter. In the second quarter, they engaged in aggressive levels of quantitative easing. They put another 8.6% of GDP back into the economy with all of their stimulative measures. Number one being a lot of quantitative easing where they're buying up all types of securities in the fixed income markets for a couple of reasons. Number one is to provide liquidity to ensure that when people want to transact, there is a valid and available market there. And secondarily, for those businesses that had dropped down into high yield status after the pandemic began, they wanted to provide additional levels of funding, so they were buying up some corporate paper for those what we consider fallen angels, people who are companies that have gone from investment grade down into the high yield space. So tons of stimulus there. Also, the global economies had seen that because China was the first one subject to the main pandemic, and then the subsequent aggressive actions to force people to stay at home, and then the subsequent turnaround that they've experienced after the pandemic had basically passed. They still have minor little bouts of coronavirus activity, but for the most part, it has passed. and they have seen good economic growth subsequent to the quarters, late in the quarter's end. So as investors had seen that, that was also stimulative to the economy. And we also saw pretty nice improvements in the unemployment situation during the second quarter. Coming into the financial crisis, the unemployment rate moved up as high as 14.7%. It has subsequently declined to the most recent reading as of August 31st, down to 8.4%. And so when you look at all of these factors in conjunction with the big correction we saw in the first quarter, that lent itself to aggressive performance in the US equity markets and in the fixed income arena as well. It was very much of a risk on quarter. If you look at the table on the top right-hand side of page 3, you can see that in the US here, the small cap stocks, that's the Russell 2000, they performed the best, up 25.4% during the quarter. Mid caps behind that at 24.6%, and then the large cap with the S&P as the proxy for large cap equities up 20.5%. So a very aggressive return in the markets here in the second quarter. In the S&P 500, it was the most aggressive quarter that we had seen since 1998. So just to give you
The agenda.
magnitude and scale there. Also note that as of quarter's end, the S&P 500 was still down year to date to the tune of about 3.1%. Since we rebounded and continued aggressively into the third quarter, we are now in positive territory, albeit we've pulled back pretty aggressively in the last couple of days. As of Friday's close, I think the S&P was up about 3.8%. Also in the table, you can see it was not just a US affair. Performance was pretty strong in the international space. Emerging markets, the most aggressive segment out there, up 18.1%. That's the MSCI EM index. Then the MSCI EFA index, that's developed international stocks. Those were up 14.9% during the quarter. So it was a very strong market across the globe as people anticipated that we were going to get out of this within a reasonable period of time. Looking at the graphic on the bottom right-hand side, I think it tells an interesting story. The blue bars that are all pointing to the right basically show you that all sectors of the S&P 500 had positive performance during the quarter. However, there was a significant distinction in terms of return differentials between the different sectors. As you can see, consumer discretionary stocks were performing the best here during the quarter, up 32.9% versus 30.5% for technology. But then if you look all the way down to utilities, up 2.7%. So quite a bit of a difference depended on where you were invested. That would impact your performance quite significantly. It's also quite interesting if you look at the green bars, and there's a mixture of those pointing left and right, but that's performance on a year-to-date basis by sector. And so it's quite interesting there. If you look at the only ones that have generated positive performance through quarter's end as of 6/30 were technology and consumer discretionary stocks. And interestingly enough, there's only 3 sectors that had actually generated positive earnings growth during this third quarter on a year-over-year basis. And again, technology, consumer discretionary, and communication services there. So it was very important as to how you were allocated as an investment manager during the quarter as to how your performance came out. The big challenge, though, is that earnings during the second quarter, albeit they were better than expected, if you look at the valuations in the equity markets, they were quite rich. And I think that's one of the primary reasons why we experienced the correction that we've seen over the last couple of days. Equity markets, particularly technology stocks, have moved up very aggressively here as of late. And I think the most recent correction is really just that. It is a correction of excess movements higher. A couple other points. The dollar on the quarter was down 1.67%, still up as of 6/30, still up year over year by about 1.3%. But it has been coming off quite a bit relative to the euro on a year-to-date basis. It's actually down about 5.6% versus the euro. If you'll turn to the next page 4, in the fixed income arena, it's very interesting. And I think the graphic on the bottom right-hand side of the page really shows you exactly what happened. What we saw during the second quarter was basically a near complete reversal of what happened in the first quarter. In the first quarter, as the financial markets were kind of falling apart, the economy was, everybody was concerned the economy was going to fall apart. Interest rates, spreads, most importantly, widened out dramatically, meaning that the best place to have been from an investment perspective was in U.S. Treasuries. And that's often the case when you're in periods of financial crisis. So Treasuries moved higher, much more so than corporates did during the first quarter, but nearly all of that was reversed in the second quarter. About 60 to 80% of the spread widening that took place in Q1 was reversed in Q2. So in the second quarter, if you had a larger allocation to corporate bonds and basically non-treasury securities, you performed quite well. If, for example, you look at the table there, and if you look at the line Bloomberg Barclays US Intermediate Government, that was up 0.5%. But if you look at the line just below that, which is a credit index, or basically a non-treasury, non-governmental index, you can see quite a disparity in return differences, up 6.7% during the quarter. So again, as much as it was a risk-on environment, it really showed up aggressively in the fixed income arena in the second quarter. Fortunately for the active managers we're using in the portfolio, as much as they were challenged and underperformed to a decent extent during the first quarter, they came back very aggressively and outperformed very aggressively in the second quarter as a result of their overweight typically to non-treasury product. You can also see from a risk-on perspective that high yield fixed income performed well during the quarter, up 10.2%, and emerging market bonds, that's the very bottom line there, were up 11.2%. So very much of a risk-on environment, with the market looking forward and anticipating that we would be getting out of this pandemic in relative short order. Turning to the next page, the US economy. As I had mentioned, we'd seen some pretty decent reports. Most recently, unemployment moved lower to 8.4%, down from 10.2%. That was quite a bit better than expected. We'll see our economic forecasts have not yet been updated for unemployment, as we were looking for a year-end total at about 9.5%. So that's obviously not where we're likely to end up. It is expected that we will continue to move lower. I read a recent report from Goldman Sachs that said they think unemployment is going to get down to about 7% by year's end. We also saw aggressive moves lower in GDP in the second quarter, as everybody was anticipating. It wasn't a big surprise there. What's going to be more interesting, though, is what happens here in the third quarter. From all of the positive economic data that's come out, more and more revisions to the upside in third quarter GDP. I had seen some numbers originally. Wells Fargo was looking for 20%. Goldman Sachs, some of their earlier estimates were at 26.5%. Now Goldman Sachs is looking for an increase of 35% in GDP in the third quarter. So this is kind of playing out as many expected, albeit the rebound has been a bit more aggressive than expected. Citibank puts out an surprise index, and it has recently exceeded the highest level it's ever been in its history. So that means that economic indicators are coming out significantly stronger than most people had anticipated. So that's a good thing. If you look at the graphic on the bottom right-hand side of page 5, that's a forward-looking set of indicators. Those are the ISM surveys. One line represents the services index and one line represents manufacturing. The important point is that when they exceed 50, that points to expansion in those segments of the economy. And in fact, that's where we are. So those have come back pretty aggressively. Things look pretty good at this point in time, albeit not as good as what we had expected coming into the year before the pandemic took place. But the ISM manufacturing survey was at 54.2 recently, and the services survey was at 58.1. So those are looking pretty good. Then if you turn to the next page, what's happening globally? The big issue more than anything else is because of expectations for negative GDP globally this year, those countries or economies that are more export dependent are expected to actually underperform. So countries like Japan, the European Union, South Korea are expected generally to underperform in terms of their financial markets. as a result of the export dependency that they have. So from an overall allocation perspective, if we were to be overweight any segment of the global economy, it would be to the US as opposed to the balance. Now, those economies have been performing not as well as the US, as the US has snapped back. But if you look at the bottom detail there, China has snapped back pretty aggressively. As they were the first ones through the pandemic, they are coming back quite aggressively. I think one of the biggest factors there was the fact that they really aggressively quarantined everybody as much as possible and basically shut their economy down. And so now that the pandemic has basically gotten under control, their economy has come back quite significantly. If you look at the blue line in the graphic in the bottom right-hand side, that's the Chinese Purchasing Managers Index, similar to those ISM surveys. When you're back above 50, that's pointing to expansion. So the Chinese economy is expanding at this point in time. And that gives many people in the balance of the world some sense of relief that we will be able to get through this. It's a little bit of a mixed picture globally. We do expect GDP on the globe to be negative this year, down. If you turn, actually, let's take a quick look at page 7. Here we've got our forecasts. You can see there in the table on the top left-hand side of the page, we're thinking GDP globally would be down about 3.3% this year overall. And that'll have its effects, especially on those export-sensitive economies. US GDP in aggregate, our forecast is still for down 4.5% in all of 2020. I have not yet seen a revision to that. Unemployment, as you can see, we were originally forecasting 9.5% at year's end. I expect that to be revised, and I'll share that as those details become available. So we think we are on the mend at this point in time, but we don't anticipate huge levels of growth in aggregate across the economy. Certain sectors are likely to perform better, but we think given the valuation of the market, because the market has come back so aggressively, that we're not likely to see significant movements higher from here. I think with the coming elections and the uncertainty that brings in conjunction with the current market valuations, we're going to be subject to basically decent levels of volatility with a sideways to maybe slight upward trajectory within the US financial markets. If you look in the top right-hand side of page 7, one quick point, from an expectations for fixed income yields during the end of the year, we think that the 10-year treasury will get up to probably no higher than 1%. We've got a revision on the data point you're looking at in your table there. We are thinking between 0.75 and 1%. Currently, they're around 67 basis points, so 0.67% currently. Any questions on that before we jump into what's happening in the account? If not, then if you will turn to page 11, we can see it's quite an interesting series of cash flows that we're looking at here, just because of the way history is unfolded here. If you look back to the 5-year number, for example, we started 5 years ago with about 50.7 million in assets. We've received a net contribution. This is contributions and distributions, so net, an additional 1.2 million came in, and we earned 20.4 million across that 5-year time period, leaving us at 72,437,000 as of quarter's end. It's interesting, however, look at the current quarter. If you look at the current quarter, we came in with about 63.4 million, had 179,000 in payouts, and earned 9.2 million. That gives you a sense of how aggressively this market has snapped back during the second quarter, which left us. Yes, please. Does someone have a question?
No, we were a little surprised at the number. It's pretty remarkable.
It is very remarkable, especially when you look at across the course of 5 years, we earned 20 million, and 9 of that during the most recent quarter, albeit there was volatility in between. And then if you look at the year-to-date numbers, still net, this is through second quarter, obviously, down 538,000 on the year-to-date basis. So that gives you also a sense of the volatility we're experiencing in the financial markets. Turning to page 12, The allocation remains the same, basically 60% equity, 40% fixed income. Then turning ahead to page 13 and 14, we can see how that breaks down across the various investments. On page 13 here, very nice diversified portfolio, exposure to large cap, mid cap, small cap, international, array of fixed income portfolios as well. And you'll see they're all allocated right to target, minor variances, but those minor variances come from the time between the most recent rebalance and quarter's end. And given the volatility that we're seeing there, it's not terribly surprising of the fact that we're off a little bit, but that's just to be expected during the rebalance cycle. If you look at the data points in the far right-hand column, I think it's pretty nice to look at that. It's always important to pay attention to what you're paying for the investment managers. And as you'll see, if you look through those numbers, you'll see some in there that are extremely low. For example, you've got 0.01, 0.03, 0.05, 0.03. We do have a pretty good chunk of the portfolio allocated to indexes. And we do that, one, to get exposure to that category, but we do it also because we can get that exposure very, very inexpensively. And if you look back in history, the number one determinant for what your overall returns are going to be is what's your exposure and what's your allocation. So the first thing that we need to pay attention to is how much we have allocated to large, mid, small, etc. And by gaining exposure through indexing, that is beneficial. And we supplement that with active management around the edges. And active management obviously does cost a little bit more, but you can still see all of the investments in the plan are still reasonably priced. If you look at page 14, just another way to look at it in terms of an allocation. We've got it allocated as percentage to the total in terms of all of the various components relative to the size of the total portfolio, but we've also got it, the view where you can look at it as a percentage of its particular asset class. So for example, on the very top fund, the MFS Value Fund is 4.07% of the total portfolio, yet it's 6.76% of the equity portion of the portfolio, just to give you a little bit of a different view of how it's allocated. And then now turning to page 15 for some very good news. As not surprising as you probably saw or reflected upon with those great numbers we saw cash flow wise, solid performance here during the quarter. Very top line is your portfolio. That's in blue. That's net of all fees. And then the index we're trying to beat, which is basically allocated in the same primary allocations as your portfolio. That's the line below it in black. So your portfolio earned 14.56% during the quarter versus 13.46% for the index. So we outperformed quite significantly here during the quarter. Same thing year to date. As much as it is negative, it is quite a bit ahead of the index. And then 1 year, 3 year numbers nicely ahead, as well as since inception. Only the 5 year number are we behind. And you can see there we're only behind by 2 basis points. So for the various changes we've made, everything seems to be moving in the right direction, and the portfolio has been performing quite well. Just a couple points of note as we look at the various components on that page. You can see the large cap value component of your portfolio performed well and outperformed the index, 14.42 versus 14.29. That was driven primarily by MFS Value. They were hurt a little bit actually because they're typically underweight energy, which did well during the quarter, but they had good security selection. Interestingly, they were underweight or didn't have any exposure, I should say, to Berkshire Hathaway and Wells Fargo, and that was beneficial during the quarter, helped them to outperform. The S&P 500 funds are tracking as we expect. A little bit of underperformance in the large cap growth space. The Voya large cap growth strategy is a more conservative vehicle. They underperformed as I would expect them to during the quarter, but it was enough to drag us down a bit so that we did underperform with the 2 large cap growth managers, but not enough to affect the whole portfolio. Mid-cap funds, again, an index strategy tracking as it's supposed to. Small cap, real nice performance there. this is actually even a little surprising to me because we do have a fairly conservative small cap offering, looking to invest in a little bit more of the larger end of the small cap spectrum and the more conservative or higher quality companies, which didn't do the best this quarter, but we still did manage to outperform. Normally, I would expect in an aggressive up move like this, I would expect our small cap portfolio to underperform by a little bit. So I was pleasantly surprised with that, but you can see more importantly with that conservative approach during the very challenging or negative environments, as you can see on a year-to-date basis, they outperformed quite significantly. And again, unfortunately, that's on a relative basis. That segment of the portfolio was down 9.04% year-to-date versus the index down 12.98. International equities outperforming quite significantly here during the quarter, 1885 versus 1612 for the index. And then, as I had mentioned, the fixed income portion of the portfolio, which was hurt during the first quarter quite significantly, a lot of underperformance there, came back very aggressively because of their increased exposures to non-treasury product in the second quarter. 463 was the return for the fixed income component of your portfolio versus 290 for the benchmark. Note, though, because of the challenges in the first quarter, you're still behind a little bit there. You can see 585 versus 614, but definitely something that can be made up in short order. And then what I'd ask you, just because I want to be sensitive to timing here, if I could ask you to quickly look at the small little handout that I had sent out, which is more up-to-date performance and asset detail. This is as of July 31st. If you look at all of the segments of the portfolio in terms of, not segments of the portfolio relative to its benchmark, at the bottom of the page there, you can see that we are now outperforming across all time periods as of the end of July. On the 3 months ending July 31st, your portfolio was up 9.8 versus 8.96 for the index. 1 year basis, 8.95 versus the index at 838. 3 years, 764, a little bit ahead of the 754 for the index. 5 year, now we're just back above, up at 721 versus 720 for the index. And on a since inception basis, we are now back into the black, returning 697 versus 689 for the index. So we have continued to perform well here through the end of July. As I had mentioned, when I get the next August report, which I anticipate in the next couple of days, about 4 days, I will send that along to Vivian to share with the committee. And then one last point. As of July 31st, you had 74.9 million in assets. As of last Friday, the 8th, you had 75.9. So another $1 million in gains since the end of July. That's the state of the portfolio. One point I'd ask if you turn back to the main presentation and turn to page 23. And I'll make just one other couple comments here, just in terms of the funded status and the impact the markets have had. And the good thing is that $9 million gain during the quarter was very beneficial in improving the plan's funded status. So there on the in the second column from the right, you can see that the assets increased by 9.036 million during the quarter. Liabilities, however, did go up to the tune of 1.002 million. So those are a little bit offsetting. However, you did see a net gain in improvement in terms of the funded status by about 8.033 million, which is about 9.28% improvement in the plan's funded status here as of the quarter's end. And then year to date up 0.52% in terms of the improvement in the plan's funded status here so far. So for the sake of time, that's what I wanted to cover. I do want to make sure though that if you have any questions, I can answer those. So please let me know if you have any questions.
Anybody, any of the members have any questions of Michael? No, that's pretty good results, Mike. That's a good start to the year.
There we go. All right. Even in light of these challenging pandemic times, we're all subjected to. So.
Yeah. Okay. Thank you for your time. Appreciate it.
Okay. So would you like me to drop off now then?
Yeah, I don't think if anybody has any questions, there's no need for you to hang on.
Okay, that sounds great. Hope you all have a great day, the rest of your evening, and we'll speak with you soon.
Keep the good results up. Next quarter, we want to hear the same thing.
Sounds good.
Okay, thank you.
Thank you.
All right, the next item on the agenda is the approval of the June 9th, 2020 Special Trumbull Police Pension Board Minutes. Do we have a motion?
Make the motion.
Al Zimmer.
Second?
I'll second the motion.
Any discussion? Hearing no discussion, we'll come to a vote. All those in favor signify by saying aye.
Aye.
Any-
Commissioner Trust, excuse me,
Motion.
Chairman Baldwin.
What's that?
Commissioner Trust needs to abstain.
No,
Okay.
because I wasn't present last time?
Correct.
Okay, I abstained.
Thank
All
you.
right. All right, the next item on the agenda is a notification of the passing of surviving spouse Catherine Ebling of retired Captain Jonathan Ebling. I don't know, does that require any action on our part?
I can handle those two, Commissioner. So we were notified by Catherine's family that she passed away on July 19th, 2020. And once that occurs, the board has to stop payments because there's no other, obviously, surviving spouse. She was the surviving spouse. So as of August 1st, 2020, I make a motion to stop the pension benefit payments to Catherine Ebling.
Do we have a second?
I'll second it.
Second? Any
Am I
discussion?
still abstaining? Do I still have to abstain, or am I in on this one?
No, you
Good,
don't.
Commissioner. New business.
Do business.
Let me
You
know
don't
who
have
seconded the motion, Chairman Baldwin.
motion. The motion was made by, I'm getting a lot of feedback here.
Bobby Capola made the motion. I just need to know who seconded the motion.
I think
I
Chief,
seconded it. Al Zamri.
Thank you.
okay.
And can I just mention one thing before we vote?
Yes, go ahead.
In the email, Ms. Ebling's son, Clayton Larson, thanked the department for supporting Captain Ebling and Mrs. Ebling during their retirement years. So for the record, I just want to let the board know that their son is very appreciative in their email.
Okay, thank you. All right, and no other further discussion. Come to a vote. All those in favor? Aye.
Aye.
Any opposed? Any abstentions? Okay, the motion carries. Next item, passing of surviving spouse Grace Kaloji, retired Officer Ray Kaloji. I assume you have the same thing, Bob?
Yes, so as we received an email, and as of August 23rd, 2020, Miss Kaloji died on August 23rd. We were informed, and I'm not sure who told us. I don't have a note here. Viv, do you remember who notified us?
For her, I think it was the daughter.
Okay, so, I just, for the record,
But you should have
condolences to the family. But yeah, so Patrol Officer Kaloji, his wife Grace, passed away on August 23rd, and I make a motion to stop her pension benefits as of September 1st, 2020.
Okay, we have a motion. Do we have a second?
I can second that.
Do we have a second? Do we have any discussion? Hearing no discussion, we'll go to a vote. All those in favor signify by saying aye.
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 Any opposed? Any abstentions? Okay, is there any further business to come before the commission? Before the pension board, rather? Okay, hearing none, entertain a motion to adjourn.
Make the motion.
I'll make a motion, Capola.
Okay, do we have a second?
I'll second it. Al Zamri.
Okay, all those in favor signify by saying aye.
Aye.
Any opposed? None? Okay, thank you, folks. Have a good evening.